Rupee at the edge, currency stress, sector rotation, and the new market reality. The Indian rupee slide towards the psychologically important 89 to 90 level against the dollar is not an isolated currency event. It's a signal, quiet, structural, and deeply intertwined with global capital flows, domestic economic consumption, and investor psychology. When a currency weakens persistently, it begins to reorder incentives across an economy. Exporters are rewarded, importers are punished, balance sheets are reshaped, and markets begin to rotate capital not on optimism but on survivability. India now stands at such a moment. The recent depreciation of the rupee has unfolded amid a complex convergence of global risk aversion, delayed geopolitical and trade clarity. A firm US dollar environment, expectations of aggressive US Federal Reserve cuts have faded, pushing capital back towards the dollar asset. At the same time, uncertainty around the US-India trade negotiations have moved a potential positive catalyst that could have stabilized sentiment. In this environment, emerging market currencies have come under pressure, and India, despite relatively strong macro fundamentals, has not been immune. Yet, a falling currency doesn't affect all parts of the economy equally. In fact, it rarely does. What the rupee's decline has triggered is a clear sectoral bifurcation, a market-led judgment on who benefits from currency weakness and who absorbs its costs. The mechanics of a falling rupee. At its core, currency depreciation changes relative prices. Revenue earned in foreign currency translate into more rupees, while costs denominated in dollar become more expensive. This is a simple arithmetic, has powerful consequences. For companies that earn in dollars, spend in rupees, margin expand automatically. For companies that earn in rupees but rely on imported inputs, margins compress just as mechanically. The stock market, forward-looking by nature, begins to price this divergence rapidly. This is precisely what has been unfolding. As US INR approached record levels, capital began rotating decisively towards export-oriented sectors, while import-heavy industries started to face valuation pressure. The movement was not driven by euphoria, but by relative insulation from currency stress. Why IT services emerge as primary beneficiaries? Among all sectors, India's IT service industry stands out as the most direct beneficiary of a weaker rupee. The business model is almost custom built for such phases. A dominant share of revenue, often between 70 and 90%, is earned from clients in the United States and Europe, denominated in dollars. Meanwhile, the bulk of operating costs, especially salaries, infrastructure, and overheads, remain rupee-based. As a result, every incremental dollar earned becomes more valuable in domestic terms, even without volume growth. Reported earnings can improve simply due to currency translation effects. This explains why IT stocks often outperform during periods of rupee weaknesses, even when global tech spending remains subdued. Market behavior reflected this reality. The Nifty IT index moved higher even as broader benchmarks showed caution. Investors were not suddenly optimistic about global growth. They were relocating towards businesses whose cash flows are naturally hedged against domestic currency depreciation. However, this advantage comes with an important caveat. Currency-driven gains are not the same as demand-driven growth. Analysts have repeatedly cautioned against chasing IT stocks purely on rupee weakness because sustained outperformance ultimately depends on global technology spending cycles, not just exchange rates. Pharmaceuticals, currency tailwind meets structural strength. India's pharmaceutical sector occupies a slightly different but equally interesting position. Like IT, pharma companies derive a substantial portion of revenues from overseas markets, particularly the United States. A weaker rupee boosts export realizations, improves pricing flexibility, and enhances competitiveness in regulated markets. Unlike IT, however, pharmaceuticals are also influenced by regulatory dynamics, price control, and compliance costs. Currency depreciation helps, but it doesn't override issues like the US FDA inspection, generic price erosions, or product concentration risks. That said, in an environment of currency stress, pharma offers investors a combination of export exposure and defensive demand characteristics. This is why pharma stocks showed resilience and modest gains even as broader market sentiment remained cautious. They are not purely currency they are not purely currency plays, but in periods of rupee weaknesses, the exchange rate becomes a meaningful margin stabilizer. Exporters beyond IT and pharma, the limits of currency advantage. Beyond IT and pharmaceuticals, other export-oriented sectors such as textiles, chemicals, specialty manufacturing theoretically stand to benefit from a weaker rupee. In practice, the advantage is more limited. Many of these industries suffer from high import intensity, raw materials, energy inputs, or intermediate goods priced in dollars. As a result, the currency benefits on the revenue side is often partially or fully offset by higher input costs. Moreover, India's overall export growth has been relatively stagnant, constrained by global demand conditions and competitive pressures. This is why market performance in these sectors has been mixed rather than uniformly positive. Currency depreciation alone cannot compensate for weak external demand or structurally thin margins. Import-heavy sectors where the pain concentrates. If exports gain quietly, import-dependent sections absorb the stress loudly. Aviation is one of the clearest examples. Airlines earn primarily in rupees, while key costs like jet fuel, aircraft leasing, maintenance are linked to the dollar. A weakening rupee raises operational costs almost immediately, squeezing margins in an industry that already operates on thin profitability. Even modest currency depreciation have outsized effects on earnings. Oil and gas face a similar change at the macro level. India imports the majority of its crude oil requirements. When the rupee weakens, the landed cost of oil rises, complicated inflation management and pressuring downstream companies. While upstream producers may be partially insulated, the broader energy ecosystem becomes more vulnerable. FMCG and paints can also feel the strain. Many raw materials such as crude-linked packaging inputs or titanium dioxide are imported. Higher input costs either compress margin or force price hikes, which can hurt demand. In a consumption-sensitive economy, this trade-off is never trivial. Electronics manufacturing services face perhaps the most direct hit. These companies rely heavily on imported components and sub-assemblies. A weaker rupee inflates input costs, and unless these can be passed on to customers, profitability suffers. This is why EMS stocks have struggled during the periods of sustained currency weakness. Market react. Selective strength and broad caution. The equity market's response to the rupee's decline has been telling. There has been no panic but also no complacency. Sectoral indices moved in different directions, reflecting a rational repricing of risk rather than indiscriminate selling or buying. IT and pharma showed relative strength. Broader benchmarks like the Sensex Nifty remained under mild pressure, signaling caution rather than crisis. The divergence underscored a key point. Currency stress manage Currency stress doesn't automatically translate into market collapse, especially when institutions believe it's been managed. The role of the central bank, stability without alarm. Throughout this phase, the Reserve Bank of India has played a crucial role stabilizing the rupee. Reports of intervention in both onshore and offshore markets helped the rupee recover modestly from its lows, reinforcing confidence that the central bank is monitoring volatility closely. Importantly, policymakers have emphasized that a gradual depreciation is not inherently dangerous. In fact, control currency weaknesses can help correct overvaluation and support exports. The real risk lies in disorderly moves, sharp, sudden declines that unanchor expectations and fuel inflation. So far, that line has not been crossed. Inflation remains anchored, fiscal discipline has improved compared to early cycles. Foreign exchange reserves provide a buffer against extreme volatility. India-US trade uncertainty, the missing catalyst. One of the reasons the rupee remains under pressure is the absence of a positive external trigger. A successful conclusion to the India-US trade negotiations could have provided such a catalyst, improving sentiment and attracting capital inflows. Instead, delays and ambiguity have kept investors cautious. Trade agreements are not just about tariffs, They signal geopolitical alignment, policy predictability, and long-term access to markets. In their absence, currency markets tend to price uncertainty conservatively. This is exactly what has happened. Retail investors between fear and opportunity. Pref- Perhaps the most complex impact of the currency depreciation is psychological. Retail investors see the rupee falling, headlines warning of record lows, and markets move unevenly. The instinctive question, should I buy now, reflects uncertainty rather than conviction. Analysts have broadly advised restraint. Currency movement alone are not sufficient grounds to alter long-term assets allocation. While sectoral opportunities exist, chasing stocks purely on exchange rate dynamics can be risky if underlying fundamentals do not support sustained earnings growth. For long-term investors, the message is clear. Understand the structural drivers, not just the headline number. A falling rupee rewards some business models and punishes others, but it doesn't invalidate disciplined investing. Conclusion: a repricing, not a crisis. The rupee's slide down 90 is not a verdict on India's economic health. It is a repricing of risk, of competitiveness, and of sectorial resilience. Export-oriented industries like IT and pharmaceuticals gain breathing room. Import-dependent sectors face cost pressure. Markets respond selectively. Policymakers manage volatility without panic. What matters now is not the exact level of USD/INR, but the trajectory and the response. If depreciation remains gradual and policy credibility holds, the economy can absorb the adjustment. If global conditions improve or trade clarity emerges, the rupee could stabilize without drama. In that sense, this moment is less about alarm and more about adaptation. The currency is speaking and the market is listening, and capital is moving not emotionally but strategically.